Hey everyone, welcome in to another daily editorial here on the KE Report, chatting with Joel Elconin. We're going to be talking about what is this week seeming to be a pretty crazy round trip for U.S. equity markets. Starting off the week very weakly, but then being bought back at the end of this week, all coming with some big tech earnings, a Fed meeting, and jobs data. It was a busy week to digest all of this, and it's almost going to be one of those weeks it's a bit of a head scratcher because it looks like the S&P is going to close pretty much flat on the week. Now we still have a few hours of trading, but Joel is the co-host of the Benzinga PreMakret Prep Show, also editor of the PreMakret Prep website. Joel, what do you take away from a week like this where there's a lot of news, a lot of potential catalysts, and the market, while it did drop initially, pretty much flat on the week?
Yeah, Don, good afternoon. Thanks for having me. What a schizophrenic market. I mean, this market needs some serious psychological help. It will react one way to one data point on one day. Case in point, the employment cost index coming out on Tuesday. That was coupled with not great earnings from Meta. And the whole world is worried about wage inflation, right? And what the Fed gonna do? Well, Jerome calmed some nerves on Wednesday, right? With, hey, our next move is lower. We're not necessarily going higher. Then just a wicked sell off at the end of the day, just a little bit too much too fast. Thursday, yesterday, another, midday swoon, but market comes back, closes strong on the session. And then you get what's the most important thing in the market? Earnings. Now, if you want to call it financial engineering, you can because Apple's report was not that great. But when you're Apple, you increase your dividend, you increase your buyback. I mean, you can bring down your PE, not necessarily raising your earnings, but bringing that stock back in. So the street's running with it today. Apple's having a good day. And then lastly, bad news is good news, Corey. Unemployment ticked up in the U.S. from 3.8 to 3.9. So that's bad news if you're one of the people who lost your job, but it's good news if you want the Fed to cut rates. So really a mixed bag, and that's being exemplified here. The S&Ps right now are trading seven handles above Friday's close last week at 51.47.
So, Joel, just looking at the chart here, look, April through most of the first 3 weeks, pretty tough. It went straight down, the markets, and then it rebounded. Now we had this little bit of weakness here. Just on that short term chart, are you encouraged at all that maybe we have a higher low and the markets could be grinding higher, or is this simply now setting up a range in your eyes?
I can't go off the top of the range right now, Corey, with the way the market's acting. The sell in May moniker worked well. That really worked on Tuesday, and that wasn't even the end of May. But I mean, I think at this point, you really have to respect that low that you put in April. You did make a higher low, getting through the bulk of earnings season. It's a big point. I mean, the market has shown that at least at this point that it doesn't want to go back down to the low, and it's just in a tricky area because in a lot of stocks and the S&P have taken back half of their losses from the big decline, but it's like they're taking a breather. Like everyone, the intermediate traders that bought the dip, your swing traders, like, hey, I'm not holding out for all-time highs here. I'm taking my money. And then also you have, the bigger term investors that saw a big decline, the big red candle in April, and are thinking if one red candle begets another big red candle. Yesterday and today are definitely, showing some strength to start the month. But I mean, if it could clear this area with any gusto, man, I mean, there's not much here for another 50 handles to one daily high, and then another 20 or 30 handles. So when there's not resistance in the market, a lot of times the market gives you resistance, and that's happening earlier in the week, and now we're just revisiting these areas, and the market's pausing.
Man, if these markets move back to all time highs that quickly after 5 months running higher and then 3 weeks of weakness and then moving back up higher, It's hard to fight that bullish market. But let's tie this into the Fed meeting. You gave us a little synopsis there of what you heard, but big picture here is that, look, the Fed, they're not going to be hiking rates. They are still going to cut rates. We just don't know when, but they weren't very happy with how the inflation data is running in terms of continuing to go down. Are we stuck in this higher for longer, something that we have talked about, but now potentially through this whole year?
I'll be in that camp, and I kind of thought that, at the beginning. I think the turn that Powell threw at the market at the end of last year was very, very unexpected. And I think I'll just reiterate, stability for longer, not so much, yeah, higher for longer. Yeah, higher relative to where we were over the last few years. But I don't mind. I mean, having higher rates is better for people on your fixed incomes, of people that didn't want to get involved in the market. So there's a little bit out there for everybody. I don't see any hikes in 24. And also, earlier in the week, you had the whole stagflation, argument, because the inflation was, ticking up. I don't know if I can coin my own term, and it's not stagflation. I won't say it's, I guess it's stayflation. It's here, it's going to stay. And after making a lot of progress, bringing it down, from nearly double digits, bringing it down, there's going to be bumps in the road. Now, I guess investors just need to sit back and see what happens. We get more data coming out in the middle of the month for the April CPI and PPI. You do have some of your commodities that have had some nice rallies, but then again, one of the biggest factors, crude. I mean, back looks like we were going over 90 to 100, and now we're back under $80. So there's inflationary factors out there with some of the other commodities, and then there's deflationary factors with something like crude oil.
Yeah, a lot of these commodities too have stopped the uptrends that they were in. Maybe just natural corrections. Who knows? It's hard to tell right now because this has all just been developing over the last couple weeks. Any other areas within the market that you're seeing is generally stronger, the overall market averages?
I mean, your financials, we've talked about this, something like your Goldman Sachs, I mean, busting out to new all-time highs today. So your financials remain strong. The XLF is looking, perky now up near its recent all-time high. There was a little worried. I mean, the utilities. You don't like to see utilities moving up like they are, because that's kind of a flight to safety. But you just have to go to your playbook here, and your playbook is, your big tech. Have plenty of money. Your Microsoft, your Apple, Nvidia, Amazon busting out the new all-time high. They don't need money, right? They don't care about rates. There seem to be, good in a high interest rate market and a low. What you need to keep an eye on are some of these stocks that are dependent on, financing more. First Solar up $8 today, right? ENPH trading up $6 today. Solar people need to finance their projects. So the IWM, we can sit here, we can wait for the catch up trade until we're blue in the face. But until you get the turn in rates, these stocks are going to be questionable. You look at the bond market, you look at the TLT. Sure, it's having an up day, but that doesn't make you feel all warm and fuzzy about rates. So when tech seems to win in a rising interest rate or a falling interest rate environment. But you just gotta, be careful with these stocks that have a lot of borrowing needs. Just, looking at I don't know how many people we have following some of the autos, but Ford and GM also kind of rate dependent. Ford is off its recent high of the move, but I just want to alert any of your investors out there, keep an eye on this $46 in General Motors. That's the highest level it's been since early 2022. It keeps bumping its head against it, but won't go through. resistance is resistance is still is taken out. So there's another, company, little financing, dependent as well. So I still think, if you're waiting for those immediate rate cuts and that's your investment thesis, I just don't see it coming. I don't really maybe see it coming in 2024. And that's a big change where we were looking. I don't know. Some goofballs were saying, 3, 4, 5, 6 hikes in the economy. You mentioned the eyeball test here in the United States. Still, people are staying in their houses with their 30-year mortgages. Things are perhaps a little bit different in Canada because of the way the loans are set. So you guys are probably a little bit farther ahead on the recession end, but traveled over the last couple weeks. Airports are busy. Ubers are Ubering. People are still spending money, whether it's money that they're racking up on their credit card. Well, that remains to be seen. But right now, slow and steady wins the race. I just would be really cautious here if you are a longer term investor. You've seen the big declines in April. You got a nice snapback rallies today. We are out of the heart of earnings season, coming into retail earnings season. If you start to see some of these retailers absolutely fall on their face, that might be a little bit more of an indication of the R word coming into play here. But it's a two-way market. You got to look both ways. And right now, we're exactly where we at 1 week ago. So doubt next week can be as wild as this week. But in the markets, just about anything can happen.
Yes, it can. Very interesting comments there, Joel. And even look at GM. Man, oh man, that stock was just on a tear for those last 5 months. And now, as you said, kind of flatlined here. And to your point about the eyeball test, I have noticed generally slower action in restaurants in Vancouver, but housing market still seems pretty stable. So again, it's very much a mixed market, and I think a mixed economy as well. Final comments then. Time of the year. You mentioned sell in May. We just turned the calendar into May. Could this year be a tough summer because of the fact that we don't have the rate cut catalysts? We don't have even the Fed talking that much about rate cuts? Or could it maybe just be a sit on your positions type of summer where everyone tries to figure out where this market's going?
Well, I'll tell you, we had just going back a little, like over the last year, we had a 3 month losing streak, right? That resulted bottom. We all know the October bottom that turned us into a 1, 2, 3, 4, 5, 6 month winning streak, right? Man, down in April. We're up in May. We're up in May. I just think it's one red candle usually begets another red candle. I know we're quite a bit above it right now, basis the S&P, but I'd look for those April closing in your stocks where you were marked at the month of April. So far, that April close has been vigorously, well, forget about that a week ago Friday. But on the dailies, and that wasn't even in the quarter. So we're only the third day of the quarter. Look at your parameters. As long as we hold the week, the lows for the week, which was made yesterday, boy, seems like a long ways away. That 50.36, then hey, we're turning the quarter. The month ended at 50.67. So if we're in a trading range, yep, this is probably a good place to think of it as an intermediate top in that trading range.
All right, Joel. Great chatting with you. Always appreciate our Friday calls and how you're viewing the markets this week. Just a very interesting and random week with all the news. And now, when we take a step back, the lack of any market movement on the back of that. So, still, I think a lot of people wondering where the next trend is going to be. Joel, thank you so much for your time. I'll post a link to the PreMakret Prep website below. We'll hopefully chat next week. I hope you have a great weekend.
Okay, you too, Corey. Thanks for having me.